David, what camp are you in the idea that they risk more by not cutting or risk by cutting too soon?
We basically feel they're navigating it quite well, and we're less concerned whether they start to cut in June, July, or August. What's clear to us is the Fed is going to be cutting this year, and the economy is strong. And we think those two things together allow for a constructive stock market. The stock market becomes obsessed on a day-to-day and data point basis in terms of, is it going to cut, is it not going to cut, and you're going to have volatility. So we think shorter term, you're probably in a trading range with maybe 5% upside, 5% downside. We'd be buyers into any dip. We wouldn't chase the rallies. And we think ultimately the year ends higher than it is right now. And we would not spend too much time trying to predict the Fed because it's impossible. And they're changing with each data point, and the data points, are going to be changing in the next few months.
Hey, David, I had a strange thought this morning that probably is an old thought. It's probably a thought you've had for a long time. But here's the weird idea of it. The longer the Fed remains at a high level, in one sense, it's better for the market because the more ammunition the Fed has to fight the slowdown, which is a sort of a long way of saying at 5.38% with inflation either stagnant or going down, the Fed put looks to be well in place.
I think that's a great assessment. We think the Fed, has flexibility, and if inflation is coming down, as we think it is, they're going to be able to lower rates and maybe more quickly when they need to. The only concern we have on the economy right now in terms of interest rates being as high is in the housing market because it's a very complicated environment. Mortgage rates are so high that it's very difficult for people to sell their homes because if they buy a new home, they have much less ability to buy or spend up on that.
Yeah, and Steve just brought us the headlines from Goldsby talking about housing inflation. Here I am asking you about commodity inflation. What do you think is the bigger risk here, David?
Well, we think that in terms of commodity inflation, that by and large is pretty manageable. We don't think oil prices are related directly to the economic activity in the U.S. There's so many other factors going into it in terms of geopolitical, in terms of what's happening in the Middle East. We think ultimately right now that oil prices at the higher end of their trading range, we do expect some relief over the next few months. So while it might hit an inflation number over the next month or two, we think 3 to 5 to 6 months out, oil prices are not going to be a negative for inflation numbers because we think prices will start to trend down into the 70s.
One of the things you want to think about with what Goolsbee just said, I don't think he's saying this, but it's not crazy to think it. Should the Fed look through the housing component in deciding whether or not it's arrived? Because maybe David has a brilliant answer. Maybe you do. Diana didn't yesterday, and none of the brilliant housing people I've talked to know. Is the answer to housing inflation higher rates or lower rates? Lower rates will give you more.
I do
David,
not
you got
have
it?
a brilliant answer on
You
that.
don't have it.
I do
Nobody
not have
does.
a brilliant answer on that.
Nobody does. Do you fix the housing market by lowering rates to
So
increase
you have to
supply?
set it aside.
Or do you lower? Here's the problem. If you lowered rates, and we talked about this yesterday, are there more buyers and sellers? Here's my conclusion. Every seller needs a place to live. So if you increase the number of housing on the market, you don't necessarily increase net supply. Every buyer necessarily it may be living on the couch at home. I'm serious about that.
No,
That's actually a real phenomenon.
Yeah.
So if you make it easier for buyers, I don't know if that helps.
You see the numbers follow. Last word to you, David. I want to talk about some of your picks. We've seen this broadening out of the rally this year, but today, and really mega cap tech hasn't traded on rates or yields even. They've just moved higher. What do you expect for the rest of the year? Are you broadening out?
We think the market is going to be broadening out. You're already seeing it. We think that continues as the year progresses. We're still comfortable with technology. We just don't expect lights out performance for the rest of the year. But we think other sectors that have finally started to do better are going to continue. Buy a broad basket. We like healthcare right now. We like financials. We like industrials. We still like some technology, but we're more focused on the lagging technology where we think some of those stocks are going to catch up. And utilities have been an absolute dog. We think as the Fed ultimately starts to lower rates, utilities are going to be a pretty good place to be. Yeah.